All right, great. Hello, everyone. This is John with PERA Advisors. Thanks for joining today. Today, we're going to do best practices on approaching PERA appointments for life insurance agents and life insurance opportunities. With us, we have a special guest, Kevin Goodwin, president of Overwatch Financial. And I'd like to turn it over to Kevin. Kevin, thank you, everyone, for joining. And Kevin, if you wouldn't mind opening up with some of your strategies and personal best practices on insurance.
Okay. Yeah, well, guys, what I'm going to do is I'm pretty much going to go through the entire process that we use for our PERA appointments and kind of how we approach them and how we, process those appointments and how, little tips and tricks and things that we've learned over time that we can utilize when we're meeting with clients when we're insurance licensed only. So basically, one of the questions that was asked, they gave me a few questions is when an appointment comes in, what to expect, what do you do, when do you contact them, that type of thing. And really, as far as that's concerned, you really leave all of that up to PERA. So the initial email that goes out to the participants, pension participants, is basically says, hey, if you'd like to meet with somebody to discuss your pension or your 403B or this or that or the other, click here on this link and schedule an appointment. And then once they click on that link, they go in, they schedule the appointment, and then we immediately get notified once it gets assigned to us. Now, they also get a confirmation email. And in that confirmation email, they get a link that basically says, if you need to change, modify, or delete your appointment, then click here. So they are immediately given that opportunity to do that. If they made an error in their appointment, whatever, they're given, PERA handles that. So we don't handle any of that in our office. Then 24 hours before the appointment, PERA sends out another confirmation email. It's just a reminder, hey, your appointment's 24 hours from now. We do not want to communicate with the client before that 24-hour email goes out. Because if the client does want to cancel at that point in time, they'll click right there on that link and they'll cancel it. The nice thing about that is it got scheduled into your calendar, but when they go in on the PERA link and they take it out, then it immediately comes out of your calendar. And so, you don't have to worry about it. You were never charged for it. So PERA charges for the appointment the day that the appointment is held. So if they're canceling by clicking on that 24-hour advanced 24-hour warning, hey, your appointment's tomorrow, reminder is probably a better word than warning. But, if they click on that link, you're never going to get charged for the appointment. It just pops out of your calendar. You're good. Now, the primary reason my office does not reach out to somebody prior to that 24-hour appointment coming out is because if we send out a Zoom link or something like that to schedule to say, hey, here's how we're going to connect tomorrow, here's the Zoom link, then what happens is the client may click on that appointment, may reply to that email and say, hey, we don't want to meet, or we need to reschedule, or we need to cancel, or whatever that may be. And I don't want them to do that through my staff. I want them to do that through the PERA portal. And that's why we don't have my staff send out any emails until like the night before. So like 4 o'clock before they're getting ready to wrap up for the day. That's when they're sending out those PERA the Zoom links for our virtual appointment, because at that point in time, they've already been given plenty of opportunity to cancel via the 24-hour appointment reminder email that they get from PERA. So we do not reach out to anybody until the evening before, and then we just simply send them a text and we say, hey, we are sending the Zoom link to your email. Please reply if you don't get it. And then we send them the Zoom link to their email, and then they typically will show up in the meeting the next day. So when they go into the appointment, you have to understand what they're there for. They are there most of the time, I would say over 90% of the time, they know that they are there to talk about their pension. Some people are there for specific purposes, like they have a specific question. Some people are just general information. I don't know where I'm at. I've never done one of these before. Wanting to find out what their pension and their benefits are going to be for them. So right up front, I try to establish that. What is it specifically they're there for? So, you know, we jump on the Zoom appointment. I basically say, hey, you know what, let me introduce myself. My name's Kevin. But I always like to ask at the beginning of these appointments if there's something specific that when you got the email saying that you can meet with somebody, was there something going on, something that you said, oh, I need to meet with them because of this, or if it's more just general information, you want to see where you're at with your retirement and make sure you're on track. Because I want to make sure you get out of this meeting what you came here for. So I give them the opportunity right there to say, and a lot of times they'll say, yeah, I do, I have this specific question, and you know, they'll give you the question. Most of the time it's general information, want to see where I'm at, make sure I'm on track, okay? Now, if they have a specific question, you don't want to answer that right there. You can say, okay, absolutely, I will make sure we address that as we go through our appointment, because otherwise if you answer that question right there, you don't really have any opportunity to, you know, discuss anything else with them and potentially win any business. So at that point in time, I have a form, kind of an intake form that I use, and it has a formula right in the middle of the page. So at the top, it has just, you know, their name, their date of birth, their birth date, that type of thing. And then in the middle of the page, it has the actual pension calculation. And I will get that form to John, and then he can include that here. Send that out to everybody here on this webinar. But what it does is it basically gives me the formula right there in the middle of the page. And most pension plans are very similar to this. It's your years of service times a multiplier times you know, your average monthly salary, and how that average monthly salary is calculated can vary from state to state. But that's typically what we're going to be looking at. And so that formula is right there in the middle of the page. It's kind of a little form that I just fill out, and I say, okay, they've been here, you know, 14 years. They plan on working another 10. They're going to have a total of 24 years, and I do that calculation with them right there on the phone. And understand the reason I do that with them right then and there at the beginning of that appointment is because, let's be honest, that's what they came for. When PERA sent out that email, they said, hey, somebody's going to discuss with you what your benefits are. Somebody's going to discuss with you, you know, what you can count on in your pension. And you can't go into these appointments with the assumption that I'm going to get them in the appointment and then I'm going to try to flip this appointment into a sale without providing them something that they came there for, or it's just not going to work. So I always right up front, I give them what they came there for. They came there to get somebody to discuss their pension benefits with them. I give that to them so that we fulfilled the obligation that was given to them when that email went out and said, hey, we're going to do this. So right off the bat, I do that, and then shortly thereafter, you know, what I do is I say, okay, so looks like based on our calculation, your pension's going to replace approximately 55% of your current income. Now, what are we doing in order to replace the other 45% of your income? Okay, and this is kind of a surprise to a lot of people. A lot of people think, you know, the old days, you know, the old pensions, you know, you work some in a place at a company for 30 years and then you get paid the same amount of money the rest of your life. So oftentimes it's kind of an eye-opener when you do that calculation with them and you say, okay, you're only going to get 55% of your income. And you can ask questions like, you know, would that be difficult to live off only 55% of your income? Okay, and do you think that's going to get easier or harder over time? You know, with inflation, I mean, things go up in price, they don't go down in price, right? So, you know, you can certainly, you know, kind of push that if you feel the need to. But basically, you know, what you want to do is you want to establish what their shortfall is. So, hey, it looks like you're 45% short. What are you doing so far? Now, some of this is psychology there that you want to apply to that, and it's automatically being applied when you ask that question, because what it's doing is it's creating a little bit of pain, okay? It's showing them, oh, crap, what am I doing for that other 45%? So when you start asking the next questions like, do you have a 403B? Do you have an IRA? Does your husband have a 401k? When you start asking those other questions, you earned those answers, because now they want to know, hey, where am I going to get that other 45% of my income? So it's a great technique to basically get them to open up, start giving you the information that they need in order for you to be able to help them. So, you know, now you start opening up to, okay, what does your husband do? Where does he work? Does he have a 401k? You've got a 403b. How much are you putting into that each month? Now, oftentimes when they go into these appointments, I'm going to regress just a little bit. Most of the time, when I went into the appointment in person, they were sitting there with their pay stub in their hands. And the reason they did that is because in the confirmation email or reminder email that PERA sends out, it says, hey, have your pay stub handy at this meeting. So right there, when I would walk in, I would pull it up and I'd be able to go right through that. Now, because this is not this is a virtual appointment, oftentimes they'll have it on their desk and you'll have to kind of give them some instruction. Sometimes they'll pull it up online and you'll need to, you know, maybe screen share where they can share their screen, and then you know, you can see their thing. But basically what I do when I'm looking at their pay stub is I point out, okay, right here, your employee contributions. You see right here, they're deducting $278 to go to the Arizona State Pension Plan, okay? And you'll notice over here on the other side, your employer paid benefits, look, the same $278 is right here. Now, the benefit of looking at the statement is, number one, you know exactly what program they're on, but also number two, you're also able to see if they have any other deductions coming out of their check, like a 403b. So you don't even have to ask that question. If you're in the process of getting what their average pay is and you're looking at their paycheck, we'll just glance at that column that says, you know, pre-tax deductions, and then you'll see right there 403b contribution, $50 a check. And now you know they have a 403b, and oftentimes you'll even know what provider it is because the paycheck may say Fidelity 403b program. So now you know, okay, they've got a Fidelity 403b. So now you know exactly what they're doing. And then you go to, okay, so you're 45% short. I noticed on your pay stub that you had a 403b. How much do you currently have in that 403b? How much do you have in an IRA? What other savings do you have? What other, you know, money? On a monthly basis, you're already putting away 8% of your income to your pension. That's going to get you 55% of your income replaced. How much on a monthly basis could you put away in addition to that in order to cover that other 45%? So you're asking those questions to identify how much money on a monthly basis they can afford to put away, or how much existing money they have. So this is just typical fact finding, kind of gathering the assets, kind of gathering the information that you need in order to determine what their needs analysis is. So once you've gotten that information completed, you know, now at that point in time, it's you know, committing them to basically, you know, offering them some solutions. And one of the things that I do here is, especially if I ask, you know, if I see that they're doing a 403b, or if I ask, you know, do you want to do a 403b, that type of thing. You know, one of the things I'll typically say is something along these lines. I'll say, you know, pensions bring a lot of benefits, but a lot of people are unaware of the downsides that come with a pension. And what really frustrates me is when these school districts really push hard on these 403bs. Because the reality of it is with a pension, typically your Social Security is going to fall into a classification that now your Social Security is going to be taxed, okay? So you're already in a tax hole in retirement. Your pension income is high enough that now your Social Security is taxed, so your pension's taxed, your Social Security is taxed, your husband's 401k is taxed, and then they tell you to go put extra money into a 403b, which just creates another tax situation. Well, why would we not put into a Roth IRA? Why would we not use a Roth or a Roth alternative or put into something like that to kind of start filling that tax hole with some dirt and kind of minimizing the impact down the road? Because let me ask you, do you think taxes are going to go up or down in the future? Yeah, they're probably going to go up, right? So I don't want to wait to pay taxes until later at a higher tax rate. And now all my kids are moved out. Now I'm retired. Now I don't have a mortgage. All these other things just puts us in a position where we're much better off taking that now and having tax-free income in retirement to help diversify the way that money gets taxed. So when you do that, you do two things. The first thing you do is you create a kind of an aha moment for them, a little bit of pain in the fact that now their Social Security is going to be taxed. You know, and a lot of times I'll say not only is yours going to be taxed, but your husband's Social Security, 85% of that's going to be subject to regular income tax as well. So, you know, there's kind of a hole here that we need to make sure we start filling. And so now you've created a bunch of pain because they're only getting 55% of their income replaced. Now they're only having, you know, now their Social Security is going to be taxed. Their husband's Social Security is going to be taxed. And you kind of talk about those things. So the reason you're doing this is really, you know, you can serve them any which way you want, depends on what carriers you have. If you have a carrier that has a 403B slot, payroll slot, you can certainly go in there and do a 403B. Most agents at this point in time are going in and doing a 403B, but what I typically would say when I come back, what I'll do is I'll come back with a 403B option for you, because that's what most people in your profession do. They do the 403B, but I'm also going to bring back a Roth option and a Roth alternative option. So I'm going to bring back all three, and then we're going to discuss which one of those is best for you, or which one you feel like gives you the best benefit. And then you come back in, and that's what your next appointment is. So, you know, let's say they, you know, they say, okay, I've got, you know, $300 a month I could put away. I don't currently have a 403B. So they're looking for solutions and options, and obviously if in the needs analysis and the list of assets they have IRAs or some other assets or that you can move, then that's great. Now a lot of people ask, well, can I move an existing 403B? Well, the answer to that question is that there's a lot of different answers actually. The first answer is you can always move contributions. So you can stop contributing to a 403B at any time, okay? You can then take those contributions and put them into the Roth or Roth alternative plan that we bring back. The other option that they have available is that the lump sum that's currently in their 403B, if they're over 459.5, then we can move that account, and we can move it into whatever you want to move them into. If they're under 59.5, they're still employed by the district. They have, let's say, $100,000 sitting in their old 403B. They want the $300 they've been putting in there to go to whatever plan you bring up. But now you've got that $100,000 there. Well, the answer to that question is, even if it's at a carrier that you are not approved or appointed with, let's say, for example, they have the money with AIG, and you're appointed with National Life Group, but National Life Group does have a payroll slot, so they are an approved 403B provider. You can move the money. A TPA, third-party administrator, typically will permit you to move the $100,000 that they have at AIG over to the National Life 403B. That just needs to be set up as a National Life 403B. Doesn't need new contributions, but because both providers are approved in the district, the TPA will typically approve a direct transfer or rollover between those two companies. So that's how you can get money that's in an existing 403B moved. Now, obviously, contributions we can always move and reallocate those. If you're going in and you're moving them into a Roth, obviously the way I explain that is I simply say, hey, instead of having it come out of your check, we're going to have it come out of your checking account. Okay, so right now, $50 every 2 weeks is being withheld and going into from your check. We're going to take $50 from your checking account once every 2 weeks and deposit that into the new 403B. So, or into the new Roth. So that's a very simple understanding or transition that they can think of as they stop putting money into one account and start putting money into the other. Now, the third option I typically bring back, and I really like National Life Group for this for a couple of reasons, but the third option I bring back with National Life is the Indexed Universal Life Policy. And what I typically did was I had like a summary statement or a summary report that we would prepare. So it looks very professional. It looks like you've done your analysis, you put everything together, and it's got the charts and the graphs and all that kind of stuff. But in page 1, it would have, okay, if you put this, $100 a month into your 403B, this is what you're going to get out. If you put that $100 a month into a Roth, this is what you're going to get out. If you put that $100 a month into an IUL, this is what you're going to get out. Now, the reason we do it that way is because as you're going through, you say, okay, on the 403B, this is your benefit. Let's say they're getting, $6,000 a year out in income, and that's taxable. And you just point that out. This is taxable income. Then you turn to the next page. Okay, this is a Roth, and yeah, you're only getting $5,500 out, but out of that 100% of that is tax-free. Okay, so 100% of that $5,500 is tax-free. Now, here on this other page, this one's $5,500 as well, but this is a Roth, what we call Roth alternative. It's a indexed universal life policy. So in addition to the $5,500 tax-free, you also get this $180,000 death benefit. You also get this, and then I go into the National Life Group living benefits. So in the event that you were confined to a nursing home, in the event that you had a heart attack, in the event that you had a stroke, you'd have access to this money for these reasons. So, it's kind of like bing, bang, bong. Here's the biggest one. It gives you the more bang for the buck. It's the same amount of money, same $100 you're putting into the plan, but look at all these potential benefits that you get out. And the reality of it is we don't know how you're going to use your benefits. You may live till you're 103. You may, on the other hand, pass away, 2 years from now. We just don't know. And the third plan protects you any which way that happens, whether you die 2 years from now, you die at the age of 105, or if you were to get sick, injured, have a heart attack, anything like that. This plan gives you protection all of those ways. The Roth, if you die in the next 2 years, your family is going to get the money that you put in the interest. The 403B, they're going to get the money that you put in the interest minus taxes. Okay, so you're really kind of showing them the differences and the huge increase in benefits that they're going to receive by doing the indexed universal life contract. And that's one reason I really like the National Life contract for that purpose, is because it's like, hey, I'm getting more bang for my buck, same $100 a month, but I'm getting all of these benefits, all of these potential gains from this. And so that's typically how we would handle that. Very often we would be able to close right there on the second appointment. So in the first appointment, it's just gathering the information. Okay, let's get together. Here's the next appointment. And then in the second appointment, it's, hey, when we left, I promised I was going to bring back your 3 options. Here's the 3 options. We can put that $200 a month into a Roth. Here's how that, into a 403B. Here's how that looks. You can put $200 a month into the Roth. Here's how that looks. And you can put $200 a month into the, and then it kind of had a summary page that kind of showed that the, the biggest benefit. So there's some forms there that I will shoot over to John, and he can, possibly share with you guys that are in the Q&A, or anybody else that may view this video, that you can then kind of just get an idea of how to use that. So let me see if I've answered any of the notes here.
And Kevin, thank you very much. One question I saw come up, and I know you mentioned this to me in the past, that you first identify qualifying the PERA client. Just briefly, when, sometimes agents will say, oh, this person didn't have money to invest, or this person didn't, was just getting started. Do you find that there's a certain type of client that you have more opportunity to go in a successful path, or some clients that you kind of feel that they're not qualified to move forward with you?
Yeah, I would say in general, as we would meet with people, we'd see, there might be 25 to 30% of the people that you get in front of, they just don't have any money. Maybe they're a staff, or they're not, they're not a teacher. They make half the amount of money, and or they're really close to retirement. There's just nothing you can do with them. And typically for those people, I kind of understand. Hey, this is kind of one of those pro bonos. It's kind of cost of doing business. You're going to meet with people that are unqualified no matter what. So I give them the calculation, I answer the questions, I give them the information that they're looking for, and hopefully, and it's interesting because they'll talk to other people in the hallways, they'll talk to people in the break rooms. Oftentimes, a teacher will tell it to you, oh yeah, I'm meeting with one of those guys, and they say, oh yeah, tell me how it goes and get me his card if he's any good. They don't want to meet with anybody unless the guy knows what he's talking about. And so I always go into those appointments like, hey, I'm just going to take care of this person. I'm going to do the best for him that I can at this point. And I've received referrals there to other people that were qualified because I sat there and I gave them exactly what was offered them. I mean, they were offered somebody to sit down and talk to them and discuss their benefits, and that's what I did for them. And as a result, they appreciated it, and they, so you will get that. I typically will get, I don't know, it could be as much as 30%. I don't think it's really quite that high. The other 30% are qualified. And I would say the other 60, 70% are qualified. And I would say of those, you may get 20 to 30% that won't do anything, but the other 40, you've got a high potential to close, a high potential to do business with them. Oftentimes with teachers, they're either married to another teacher, so now you got a family that's got 2 403Bs, got a lot of different things going on, they got a lot of different pieces of the puzzle they need to have put together. Or oftentimes a teacher works with a doctor or a lawyer or somebody, and so they do have money, but the teacher is just doing what she enjoys and she loves doing. So those are some of the what I would call highly qualified people, and then you can of course approach them in whatever way you see fit. But yeah, so that does often happen. It really just comes down to just taking care of everybody you meet with, and then the ones that have something to do business with, you have something to work with, and the ones that you don't. So,
and thank you for that, Kevin. That was very helpful. And my last question, in understanding that the audience here today and some others that may see this video, they're going to be new to PERA. And I know that you've seen a larger sample size in your success with us. What do you think would be a good amount of appointments to be able to see some consistent results? Because, I'm trying to share with our audience, how many appointments does it take to see some consistent, ROI?
Well, the reality of it is the more you do, the better you're going to get. So, you learn from experience, the more at bats you have, the more home runs you're going to get. It's just the law of large numbers. So if you're only seeing 2, 3, 4 appointments a week, that's why you're not hitting the goals that you may have wanted, which is why you're looking around to look at other lead generating options to fill that calendar. And, that thought process is accurate. You know, you do need to look at other options in order to get your activity level higher, because like I say, the more at-bats, the more opportunities to hit a home run. So, and that's one of the great things about PERA is whatever your current program is, it can be used as your primary marketing tool, or it can be used to complement your marketing tool, because the great thing about their system is that they are able to look at your calendar, see when you're available, and slot appointments in those slots. So if you've got other things going, great, and those things are doing well for you, great. You're just not quite hitting the goals you want, have some space in your calendar, need people to see in order to fill those holes. That's a great way to do it, especially now that we're able to do that remotely, because you're really, I mean, before, you know, those appointments that were that 30% that didn't have any money, well, yeah, but I just took, you know, 30 minutes and I drove over there, and then I went on the campus, and then I met with them, and then it was 30-minute drive home. And so what could have been a 15-minute non-qualified appointment took me an hour and a half to do. Well, on Zoom, it takes you 15 minutes to do a non-qualified 15-minute appointment. So it really has really kind of eliminated a lot of that waste for us, because, you know, yeah, we may be in front of somebody not qualified. That's okay. We're just going to take care of them real quick. We're going to move on. And we didn't drive anywhere. We didn't, you know, it was just very simple. But shoot, sorry, I lost my train of thought there.
No, I like the direction you were going there, Kevin. I was just encouraging them to see more than 5 or 10 appointments before kind of, you know, as they're testing out our the quality of our audience.
Yeah,
and you've seen a much larger sample size over time, and just to make sure, you know, we help people see that same success.
Your first 5-10 appointments, you're still cutting your teeth. I mean, you're still learning. You're still getting used to it. Over time, you know, it all balances out. And then you know, for a while we tracked. We put some time and energy into, you know, keeping a spreadsheet and tracking how many times we went to our next appointment, and how many of those no-showed, and how many this, that, the other. And the reality of it is we had very low no-show rate. We had a very high conversion rate. You know, when I look at our cost per lead, and I look at the money generated or revenue generated from those leads, that expense, you know, most of the time we're well under 10%, sometimes 12, 14% for some campaigns. But you know, it really is about the amount of time and money that you can put into it, and the number of appointments. I would say if you're not seeing a minimum of 10 appointments a week, and you're not doing that for 2 to 3 weeks, you're not going to have a real good pool to determine to start doing those numbers and those statistics. And this is coming from somebody that's got an agency that's got multiple people running PERA appointments, and I'm the one paying for those leads. So obviously I want to see a return on investment there. And, you know, if I walked into it saying I was only going to buy somebody 10 leads, I would be wasting the cost of 10 leads every time. You know, we do not have any idea what that person's stats are going to look like till they've run 30, 40 leads in order to kind of get the law of averages to work in our favor. That being said, you know, doing the same thing without making a change is, you know what they say, the definition of insanity is doing something the same and expecting a different result. So if you're failing, then look for people that have been successful to teach you what you're doing wrong, or to help you, or to give you some clues. And hopefully I've given a little bit of guidance, or you can take a couple of small takeaways from this meeting to kind of give you some guidance and help on that. But if you're struggling, it's probably because something that you need to adjust or tweak, or just the small. It's amazing how much a small adjustment will make as far as a big difference long term. So that's my recommendation is number one, give it enough time, give it enough, but at the same time, don't, if you've given it 30, 40 leads and you're still not seeing the results you want, then correct, find out what you're doing wrong and correct that, and then give yourself a little bit of time to give those to try that new process. So, but also don't try to reinvent the wheel after every single appointment, because then you'll never know what works and what doesn't work. So as far as developing your own process, those are the things that I would strongly recommend, to find success in that.
Thank you so much, Kevin, for all of your personal experiences with PERA. I know that you're highly active with us, and we're adding to your success and helping filling your calendar. So thank you for sharing with our audience today. And if anybody has any questions for Kevin, you can contact me directly, john@peraadvisors.com. And thank you, everybody, for your time today. Kevin, thank you so much. Greatly appreciate your time every time we get to connect.
All right.
And have a wonderful day, everybody. All right, thank you.
Thanks.